Welcome to the Treasury Update Podcast, coffee break sessions presented by Strategic Treasurer, covering foundational topics and core Treasury issues in about the same amount of time it takes you to drink your cup of coffee. I'll be your host, Jason Campbell, Business Development Leader at Strategic Treasurer. Chatting with me today is my guest, Paul Galloway, Senior Advisor at Strategic Treasurer. Paul, welcome back. Glad to have you.
Thanks for having me back, Jason.
I know the last session that we did, we were, kind of broke in the new year with the U.S. economy, and you gave us some wonderful insights about the 2023 outlook, or some of your perspectives on things going on from 2022 and what to look into 2023. But I want to go back even one session further, and that last one we did at the end of 22 we were talking about stocks. And I wanted to bring it back in because I thought it was kind of important as we talked about stocks in general. I think there's, I want to split it apart between two different types of stocks. And in this session, one in particular around common stock. So I think that's where we want to get a little bit further of an understanding for our audience about what is common stock. So I'm going to pose that question to you and let you take and educate me and the audience around common stock.
Yeah, Jason, when you think about publicly traded companies and anyone that is investing in a 401k has a position in common stock through their allocation of investments. And so you might not see it directly within your money fund managers. You have some level or some amount of common stock that will be in those funds, as long as it's not an all bond fund. So common stock is something that you would typically have for any company that is publicly traded. So a publicly traded company, you'll hear announcements from time to time, a company that is issuing their IPO. An IPO is an initial public offering. They're a private company that's looking to become a publicly traded company. And so privately owned companies will have stock in the company. So there'll be a set of owners, typically your founders, key executives that are part of the organization will have some type of stock ownership. It's not the common stock that people are used to seeing in the publicly traded markets, but it's still stock. It's a representation of ownership in the business. That means that anybody in a private company, when they need to raise capital or there needs to be a cash infusion into the business, they're doing one of two things. They're either putting in their own personal capital, which if they're a startup business or, relatively new and young, they're probably pouring their own capital into it because lenders aren't going to give them money on a startup. But as they grow and develop and they have products and services and generate cash flow, they're able to go to banks to get more capital. It gets to a point where they're saying, well, you know what? We can't get any additional capital to grow the business. In order to grow the business, they'll do what's called an initial public offering to capitalize the business for future growth so that they can get bigger. It also offers opportunity for people that were owners on the private side when the business was private before it went public to cash in on some of that. So they'll be able to get some value out of the business. It doesn't mean that they sell off all their shares after an IPO. That's not what happens. And certainly the market doesn't want to see these folks selling off their shares because that would make them think, well, geez, maybe there's something wrong with this company and there shouldn't have been a public offering. But common stock in the most general sense, our most widely known sense, is an issuance of equity shares in a company through a publicly traded platform.
Yeah, and I think you kind of already answered my next question, which was going to be, why a company would want to issue common stock. And I think you hit on it about, it's another way for them to raise capital. We talked about the initial public offering, that IPO. So I know there's some rumbling also too about what a secondary offering is. So can you dive in a little bit and just kind of talk to us about what exactly is involved with a second offering?
That's a great question. From time to time, you'll see companies that will go out there and they'll do a secondary offering, what's called a secondary offering. Basically what that is they're looking to do another equity raise of capital for their business. There's various reasons as to why an organization might do that. They've already got stock that's publicly traded out in the market, but they've got some very specific reasons or rationale as to why they're doing it. It may be that, they need to right-size the balance sheet, meaning, it's not quite the way they want it. They get more debt than they want, and so their debt-to-equity ratio is not where it needs to be. They don't want to extinguish debt to bring it down. They want to infuse a capital so that they can do the things they want to do, develop new products, continue to expand the business, or that's through acquisition and other things. So it's a way for them to recapitalize the balance sheet, put capital in coffers so that they can execute on the things they want to do. Another reason, a good example of why a secondary offering might happen, in the scenario of the Great Recession, 08 and 09, the organization that I worked for at the time, we were responsible for the firm's capital management. Everybody was hurting at that point, and we were looking at all kinds of different opportunities to raise capital. I ran all kinds of different analyses for all kinds of different debt funding vehicles, private, public, government, and the whatnot. But the other thing we looked at the same time was, hey, do we do a secondary offering? And ultimately what we did is we came out in the market, the first ones in the industry we were in, to come out with a debt offering. We did 2 different tranches, 5 and 10 years. But then we did 2 weeks later, we did what's called a follow-on offering or a secondary offering for equity. And, we raised $2 billion between the two. It was like $1.1 billion for the secondary common stock offering. It was really a good thing to do because it kept our balance sheet in the position that we needed it to be in from a rating agency standpoint, and also from a cost of capital standpoint, given the current environment, which was not good. And it put capital in the coffers, and it allowed us to stop focusing on our balance sheet and having Wall Street worried about our balance sheet, because we had $2 billion on the books, that we could go out and start focusing on our business and growing our business and doing all the things that we do real well with products. So secondary offerings can also be for an event like that.
So some interesting pieces that you have the initial public offering, then you got opportunities for a second offering. So one of the other pieces into common stock that I want to touch, a little bit on here is around treasury stock. And more importantly, just kind of give us a brief description of treasury stock as it relates to our overall theme of common stock. And then ultimately, how is it used?
A couple of our previous podcasts, we talked about, the management of your return of capital. And so when you think of the perspective of a return on capital, instead of doing common dividends or special dividend or extraordinary dividend, you go out and you repurchase shares in the open market. And so we talked about that share repurchase program. Every time that a company goes out and enters the market in a share repurchase program, those shares that are brought back in or reacquired are considered treasury stock. And that's what treasury stock is.
Well, that was a quick, awesome, well-described description there around treasury stocks. I really do appreciate it. Well, Paul, as always, thank you for joining me today. Really appreciate it. For our listeners, please ensure to tune in every first and third Thursday of the month for a new episode of the Coffee Break Session. As usual, if you have any questions, comments, or feedback, please send us a note at podcast@strategictreasurer.com. Until next time, take care.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.